Today, Wanted Escape Hatches, the DFA Daily to the 1st of June 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. And before I start, just a quick reminder that tomorrow, Tuesday the 2nd of June at 8 p.m. Sydney time, we're running our next live stream, which will be a special on mortgage and rental stress with data up to the end of May. You can ask a question live on the night via the YouTube chat or send them in beforehand via the DFA blog, and we will have the postcode level database online to answer specific queries. Now, according to Moody's, on the 25th of May, the European Central Bank Supervisory Board Chair Andrea Enria wrote in a letter to German Bundestag member Frank Schnaffer that he personally supported the concept of a European asset management company, an AMC, or a so-called bad bank, in the event of significant system-wide asset deterioration relating to the virus. Although Enria wrote that the ECB had no final position on the subject, the ECB's 26th of May Financial Stability Review mentions the utility of a bad bank as a means to address a surge in non-performing loans. A bad bank option would be credit positive for European banks because it would involve some degree of government support when needed, which would help banks protect their solvency and possibly avoid failures. Obstacles to set up bad banks in Europe remain. If legal obstacles decline, political ones would increase because of their reliance on taxpayer contributions. And Moody's believes that Enria's statement and the ECB's Financial Stability Review suggests that the ECB is preparing itself for a scenario in which recent measures to protect banks' common equity Tier 1, the CET1 capital, such as having banks suspend dividends and operate below some established capital and liquidity thresholds, would no longer suffice and would require stronger action, such as establishing a bad bank. In its function as banking supervisor, the ECB is seeking the continued enforcement of prudential rules, but with sufficient flexibility to help banks handle the effects from the virus outbreak. Therefore, it will provide some forbearance where it deems necessary without compromising the rules, and toward that end the ECB recently issued guidance on the implementation of IFRS 9 with the twofold objective of avoiding a massive increase in expected credit losses and non-performing loans, which might overestimate the crisis effect, and precluding too large an increase in risk-weighted assets that would disproportionately dilute banks' capital. Its strategy is efficient and effective provided that EU banks deal only with a short-lived economic contraction that does not mutate into a full-blown crisis and surging non-performing loans. Such an adverse scenario would greatly weaken banks' solvency, both CET1, and compromise their ability to help the real economy. Given that the odds of such an adverse scenario are not nil, the ECB seems to be exploring all options well in advance of the potential developments of non-performing loans, which materialise after some time lag. Most EU banks' first quarter public disclosures did not report significant ratio increases of bad loans. A bad bank solution is efficient if the disposal of impaired assets does not greatly weaken a bank's solvency. But this is not always the case, and banks are often compelled to resort to state aid in various forms. On the 8th of May, the European Commission confirmed that any government support to help banks withstand the virus crisis could be precautionary recapitalisation under Bank Recovery and Resolution Directive (BRRD) terms that involve limited burden sharing with shareholders and hybrid investors. And in 2017, the European Banking Authority's then chairman Andrea Enria advocated a Europe-wide asset management company framework that would allow each EU country to purchase distressed assets from all banks reporting non-performing loan ratios above a certain threshold. The scheme did not involve any form of debt mutualisation between European countries, which some European member states resisted. It also complied with the BRRD and with EU state rules. The European Commission followed up in 2018 with a blueprint for an asset management company. Now, I, for one, would not be surprised if we saw something similar emerge here in Australia as a way to protect our banks from risk of loss at, of course, taxpayers' expense. Meantime, the conversation around stamp duty reform has gained momentum in recent weeks at both the state and federal level, with everyone from RBA Governor Philip Lowe to Treasurer Josh Frydenberg to state politicians suggesting that land tax reform may have a role to play in Australia's post-COVID economic recovery. Reform could significantly aid home buyers through reducing the amount of money they need to have saved up front, as they're not able to borrow against stamp duty, but instead must pay it in cash. While discussion around stamp duty reform swells and ebbs on a fairly regular basis, when it comes down to it, it's widely viewed as untouchable, especially in Victoria, for example, where it makes up 40% of the state's revenue, according to Damien Rollance, Managing Director of Melbourne-based Entourage. We've always talked about stamp duty reform, but the thing is, the percentage of stamp duty hasn't changed since the 1970s, when the median house price was 30-odd thousand. It was never adjusted down as we moved into the 2000s, and house prices obviously increased, he said. Pre-COVID, it was projected that stamp duty would generate $9.5 billion in revenue for Victoria this year alone. However, now with the hope of reform feeling more like an actual possibility in recent weeks, buyer behaviour is being affected. Rollance explained a lot of agents are screaming, just make a decision on it. Because if people think reform is coming, they're worried they're going to hold off buying. With $1 million purchase, which is not uncommon these days, the stamp duty is $55,000. If people think change is coming, why would they buy now when they could save that much down the line? Even with his pragmatic acknowledgement that a reduction in tax in one place almost surely equates to an increase in tax elsewhere, Roylance has considered several alternative structures for stamp duty, which would take pressure off owner-occupiers without depriving the state its revenue. Paying stamp duty over a deferred period, say 10 or 20 years, will be a lot better for a lot of people from a cash flow point of view, rather than paying $50,000 in one go. A home buyer might instead pay $2,500 a year for 20 years, he explained, and Roylance also outlined a credit system which would help address the way in which stamp duty sometimes discourages people from transacting more. Say you buy a home for $1 million and you pay your $55,000 stamp duty. When you upgrade to a home for $2 million in the next few years, but you've given a credit for the first move you've already paid for, he explained, the buying and selling of property is so expensive. If you're able to have a credit system like this, young people moving up the property ladder could pay their stamp duty along the way. So when they buy their big home for $2 or $3 million, they've already paid a big chunk of that tax. There's a lot of flesh out there, obviously, but a credit system could help prevent people from having to pay it all again. While Roylance doesn't necessarily feel stamp duty should be lowered or altered for investors, he does see significant room for improvement, especially as it pertains to helping first home buyers into the market. The first home buyer stamp duty concession is pretty low, tiering between $600,000 and $750,000 in Victoria, but we have first home buyers buying for over $1 million. Times have changed. They're now in their 30s, just got married, and they're not looking to buy a $600,000 apartment anymore, he said. Well, it's interesting to model creative solutions which benefit both home buyers and the government. Tax reform is rarely radical. Everyone expects the change to come in the form of a land tax increase, says Roylance. However, the managing director has also seriously considered the possibility that, despite the duty dominating the discussion of late, no change will be made at all. If property prices are holding strong and people are still buying, do they need to do this? Obviously, reform is being considered as something to spark the economy and get things going again, but if it shows signs of life, why would they take away such a huge earner for the government? And according to Investor Daily, APRA has indicated that it's considering collecting and publishing more data about the early superannuation release scheme, including details around how many accounts are being cleared up to zero. Speaking to the Select Senate Committee on COVID-19, APRA Deputy Chair Helen Rowell said the regulator is thinking over expanding its monitoring of the funds and their payments under the scheme. APRA received a number of questions about how many member accounts had been wiped off all funds as a result of people accessing their super early during the public hearing on Thursday, but the body indicated that it was unable to answer that question. The chair of the committee, Senator Katie Gallagher, said the issue of drained accounts is a prudential issue that APRA should be interested in. We are currently reviewing the data that we collect and considering expansion to collect more granular information around some of the demographic and other information to do with the scheme, including the number of accounts that go to zero, Ms. Rowell said. She added, a number of accounts have been drawn down to zero as a result of partial payments, where recipients had applied for more than was in their account. And there have been around 117,500 of those to the 24th of May. That is a total of $405 million in payments, and it represents about 7% of all of the applications that have been paid to date, Ms. Rowell said. It's important to bear in mind that some of those would have been drawn accounts down to zero, but the accounts remain open because there will be future contributions. And it also doesn't necessarily equate to the number of individuals. It relates to the number of applications. And while APRA has been monitoring payments from funds, the data it publishes every 2 weeks is lagged. And despite having updated figures on hand from the ATO, which receives, approves and sends on applications to the funds, Ms. Rowell and the other APRA representatives would not disclose the newest data to the COVID-19 committee. As a consequence, it faced pushback from Senator Gallagher. Treasury released this figure to the committee last week, which was also tax office data. Do you have the updated tax office figure with you today? Senator Gallagher asked. I do, Ms. Rowell said after report. Right, but you're preferring not to provide that to the committee, even with the caveat that it's tax office data, the senator said. And APRA Chair Wayne Byers stepped in, saying the data had been provided to the regulator under a confidentiality restraint. But maybe to try and answer your question in a slightly different way, if you look at the run rate on our data and also look at the run rate on the tax office data that Treasury had released, the figure of releases would be something in the order of $14 billion, Mr. Byers said. Okay, I accept that it might be uncomfortable in terms of interdepartmental relations, but there is no area of public expenditure that this committee is not allowed to probe and scrutinise, Senator Gallagher later said in the hearing. So I'll just note that. I won't press the issue today, but it is within your capacity to provide us with that information. We would deal with it in the sense that it was ATO data and not necessarily approved released by them. And the regulator also revealed it had been given a little under 1 day by the government to consider and advise on the early access scheme when it first came to fruition on the 18th of March. We were asked to give our view on the implications from a super systems perspective, Ms. Rowell said, and the government then made changes to the regime's parameters and features, presenting the update scheme to the regulator a couple of days later. According to Ms. Rowell, the changes did not change APRA's view at a system level. ASIC, on the other hand, had not been consulted on the scheme. And now data is revealing that Australians who dipped into their superannuation nest egg during the coronavirus crisis have spent nearly $3,000 more than normal in the fortnight after receiving the lump sum, and about 2/3 of the additional purchases were on non-essentials, including gambling alcohol and furniture. New spending data shows that 40% of those accessing their super experienced no drop in income during the pandemic, or their loss was fully offset by government payments, raising questions about whether they really need the money. The analysis by credit bureau Ilion and consultancy Alpha Beta, a part of Accenture, is based on the bank transactions of 13,000 people who have withdrawn superannuation since the coronavirus outbreak. It showed those withdrawing super used it to increase, not just maintain, their spending. And their purchases nearly tripled on average in the fortnight after the money was received compared to an average fortnight before the money was received. The report reveals 11% of the additional spending by those accessing super was on gambling. As part of its response to the pandemic, the Morrison government is allowing people to withdraw up to $10,000 from their super accounts tax-free now and up to $10,000 next financial year. When the scheme was announced in March, Treasurer Josh Frydenberg said, "This is the people's money, and this is the time they need it most." The analysis shows recipients have accessed an average of around $8,000 and spent an extra $2,855 in the first fortnight after receiving the withdrawal, compared with the same group's average spending in a normal fortnight before receiving the money. Around 2/3, or 64%, of the additional purchases were on discretionary items such as leisure, entertainment, cafes, and personal care. Spending on essentials such as groceries accounted for 22%, and 14% was used to repay personal debts, including credit cards. Alpha Beta Director economist Andrew Charlton said the data showed the super withdrawals policy had been poorly conceived and poorly administered. People who access their superannuation have made one of the most expensive spending decisions of their lives, he said. And while this policy was aimed as a lifeline, what we can see is a strong likelihood of people accessing their super who really could have kept it working away until their retirement. Around 1.4 million applications have so far been approved, worth more than $1.3 billion. The most recent tax office figures show over 460,000 of those making withdrawals were under the age of 30. Angus Dockrell, a financial planner and co-founder of financial advisory firm IMFG, warned that accessing super prior to retirement could be very costly. It should be very much a last resort, he said. If you're a young person withdrawing $10,000, which was probably $12,000 back in January, you are foregoing about $40,000 or $50,000 of your retirement nest egg. To qualify for early release of super, you must be unemployed, have been made redundant, or have working hours reduced by at least 20% since January. Sole traders qualify if their business was suspended or turnover has fallen by 20% or more. Simon Bly, the chief executive of Ilion, said that the next round of withdrawals should be more tightly managed. Tools are readily available to do this digitally, he said. And Brendan Coates, the Grattan Institute's Household Finances Program Director, said it would be disappointing if 40% of those able to access the super withdrawal had not seen any drop in their income. It suggests the need for the ATO to better police the scheme and make applicants aware that penalties will apply if they have used the scheme inappropriately, he said. The finding of the spendings analysis contrasts with the results of a Bureau of Statistics household survey released last week, which asked those who had applied for early access to the superannuation about the ways they used or planned to use the money. More than half of the respondents said that they had used or planned to use it to pay household bills, the mortgage, rent, or other debts, while 36% say they had added or planned to add it to savings. And by the way, our own survey suggests a lot of them are saving for a deposit for a house. And APRA has received early release data submissions for the period ended 24th of May from 177 funds. Funds have submitted the data on a best endeavoured basis. Over the period from the inception of the scheme on the 20th of April to 24th of May, payments that have been made to eligible members have taken an average of 3.3 business days to pay after receipt of the application from the Australian Tax Office, and 94% have been made within 5 business days. Over the week of the 24th of May, superannuation funds made payments to 220,000 members, bringing the total number of payments to 1.63 million since inception, and the total value of payments during the week was 1.6 billion, with 12.2 billion paid since inception. The average payment made over the period since inception was $7,476. And the economic data continues to signal trouble ahead. The Australian Industry Group Australian Performance of Manufacturing Index, the Australian PMI, recovered by 5.8 points to 41.6 points in May after experiencing the largest single-month drop in the PMI's history in April. This indicates that Australian manufacturing contracted further in May, but at a slower pace than in April seasonally adjusted. Results below 50 points indicate contraction, with lower results indicating a faster rate of contraction. The manufacturing industry remained in deep contraction in May as COVID-19 restrictions affected demand across the board. The decline slowed across all activity indices in May, except for the exports index, which recorded its lowest ever monthly result. Exporters noted that many overseas markets have essentially shut down. They also noted higher prices for air freight into international markets that are still open to them. And many manufacturers reported that orders from their regular customers have been delayed or cancelled altogether because of the pandemic. Those supplying locally made machinery, equipment, metal and building materials to the construction industry reported a sharp reduction in new orders. And a small number of manufacturers experienced unexpected surges in demand as a result of COVID-19 for highly sought-after goods such as medical equipment, PPE, groceries, and DIY home improvement items. Private sector wages across the manufacturing industry rose by an average of 0.5% over the quarter and 1.9% per annum in the first quarter of 2020, according to the ABS Wage Price Index. The Australian PMI Average Wages Index decreased by a further 3.9 points to 45.6 points season adjusted. This low result indicates that few, if any, manufacturers were able to increase their employees' average wages in May. This was the lowest monthly result in the history of this series since September 2007, and only the third time it has fallen below 50 points, and indicating a contraction previously in July 2009 and April 2020. This fall might not reflect compensating wage payments to employees with access to the JobKeeper income support scheme, though. And according to the CoreLogic Home Value Index results for May, Australian dwelling values posted their first month-on-month decline since June last year. The national index was down 0.4% over the month, with 5 of the 8 capital city regions recording a fall in values. The reduction in values through May comes as transaction activity in the market shows more positive signs, they say. The CoreLogic estimate of sales activity bounced back by 18.5% in May after a revised drop of 33% in April. CoreLogic head of research Tim Lawless said considering the weak economic conditions associated with the pandemic, a fall of less than 0.5% in housing values over the month shows the market has remained resilient to a material correction. With restrictive policies being progressively lifted or relaxed, the downward trajectory of housing values could be milder than first expected. Across the state capitals, Melbourne's housing market has posted the largest falls over the month, down 0.9% in May, following a 0.3% reduction in April. Values were also down over the month in Perth, down 0.6%, Sydney down 0.4%, Brisbane down 0.1%, and Darwin down 1.6%. But they rose in Adelaide up 0.4%, Hobart up 0.8%, and Canberra up 0.5%. And regional markets have been more resilient to value falls, with the combined regional index holding firm through May. Although some areas have avoided a reduction in values since March, every region has lost momentum and the longer-term outlook remains uncertain. Eventually, government stimulus will wind back and borrower repayment holidays will expire. In the absence of these policies, housing values could come under some additional downward pressure if economic conditions haven't picked up towards the end of the year, Lawless said. Although housing values are currently slipping or stabilising, recent history implies most homeowners have some level of buffer that will help protect against negative equity. National home values remain 8.3% higher than they were a year ago, with Perth down 2.1% and Darwin down 2.6%, the only capital cities where values remain lower than at the same time last year. The high annual capital gain is mostly attributed to the earlier growth trajectory of housing values across Sydney up 14.3% and Melbourne up 11.7%, with the remaining capitals showing a more sustainable history of price rises. And it's worth noting that settlement volumes remain below their long-term averages, and listings are well down on trend. This week, 867 capital city homes were scheduled for auction, with preliminary results returning a 65.9% clearance rate, and the previous week saw 612 homes scheduled for auction and a final clearance rate of 62.7%, compared with 1 year ago when 1,661 homes were taken to auction and they achieved a 58% clearance rate. So much for the rubbish being spruiked about the auction clearance rates, which again are leading to misleading statements appearing across the mainstream media. Volumes are way down, so the clearance rates are, well, relatively meaningless. Rents were generally steady in May. The National Rental Index rose 0.2% over the month, following a 0.4% decline in April. The May rise was not enough to reverse a weakening trend, with every capital city except Perth recording a fall in rents over the past 2 months. Unit markets were looking weaker than house markets over the past 2 months, with unit rents falling 0.8% since March across the combined capital cities, while house rents were steady. Inner city apartment rents are looking precarious due to an imbalance between demand and supply. Hobart stands out with a more significant drop in both house and unit rental rates. And finally, here comes yet another escape hatch from the PM, with renovation grants for local tradies, not big builders. Prime Minister Scott Morrison confirmed on Radio 2GB today that the government is considering giving homeowners cash grants for renovations under a coronavirus recovery plan. The Prime Minister says cash grants will go towards supporting local tradesmen, not large contractors. The ailing entertainment sector is also likely to receive stimulus, with the focus shifting from economy-wide packages like JobKeeper to targeted assistance. We are more interested in the larger projects and new home builds and things like that, he told Radio 2GB. We are looking at a bit of a drop-off in that current home building that's going on. That's not good for tradies and not good for jobs. And he said it would be important that any construction industry measures helped local tradies rather than major contractors. This is not building school halls and all those sorts of things we saw that was done through big contractors and small contractors not getting the work and that sort of thing. We want to make sure that whatever we do in this space, the jobs get created locally. And the Prime Minister also said that he'd been in talks with key entertainment sector figures over the weekend. One of the challenges is going to be that the entertainment sector will find it difficult to get capital moving again because they've had to draw down on it so significantly, he said. And the federal and New South Wales governments will spend an extra $3.5 billion to start building the Western Sydney Airport train line this year. A big part of coming out of the COVID-19 crisis is our infrastructure spending, Mr. Morrison said. So we might ask, how much of the spare $60 billion not needed for JobKeeper will be redeployed for building more escape hatches? And let's hope the big share is going towards true national building infrastructure, not just more quick-build rabbit hutches, ready for the migration wave which we think they will activate once COVID has passed. It's a matter of priorities, and the right choices must be made. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.